do the best we can. So, I'm Linda Gerchick, and I'm the designated broker of Gerchick Real Estate, and we're excited to talk about the backside of commercial loans. If you look around the room here, and for those of you on the web, we have some of our investors here in the conference room. So if I walk around and I get out of it, you can still hear me, it's okay. But we don't have a commercial lender here, and why don't we? We're not here to sell loans. We're not here to do this. I want every investor to understand the backside of a commercial loan and how to do one. And we're going to try to talk about it. We'll talk as long as we have. We're going to stop here in about 45 minutes or so. Mike, maybe you can kind of watch me and give me a a couple minute heads up. We'll stop the video and then take a break if you will. In your packets, let's start here. It's important when you do a commercial loan that you understand the verbiage and the words and what you're going to hear, because if you don't understand that, you're not going to understand what the lender wants from you or what they want from the property. In years past, several years ago, it was weighted about 80% on the building, the loan, a commercial loan, and 20% on the borrower. Because of the new lending and the recession and all of this stuff, it's changed. So now it's about 80% on you and 20% on the building. Okay? It's not, unless you go to triple net, and that's a whole other evening with me. Thank you very much. By the way, we're at the evening. So what I've given you in your packet, number one, is a page called Investment Formulas. And if anybody ever needs one, email it to me and I'll send it to you, or email me a request and I'll send it. These are basic formulas that we use when we calculate and start working on our spreadsheets and doing these type of things with a commercial, with evaluating a property. So the first thing, and you know what, Mike, would you do me, go get my glasses off. I'm old, I can't read without glasses, sorry. So we're going to talk first of all about DCR or DCSR. Okay. Debt coverage ratio. How many people have heard debt coverage ratio? Anybody? I know you have. Do you really understand what it is? Okay, because you'll hear, I want to see a DCR of 1.1, DCR 1.25. I had an investor actually ask me for a DCR of 1.6, and I said if there was a DCR out there at 1.6, I'd buy it myself. So let's talk about it. What it basically means, and it's here on your sheet here, okay, and I found these on here, but basically what it means is that your cash flow, after you've done your net operating income, and after expenses, before debt service, what your profit's going to be in layman's terms. So if it's $100, okay, thank you so much, and your DCR, if it's below 1 or 100, okay, basic 1.1 or 1.0, if it's below 1.0, you're going to be in a negative cash flow situation, period. If it's above, you will be in a positive cash flow. But your lender wants to know if you've got, let's say, $1,000 profit and it's 1.1, they want to know that your debt service can carry it. They want to make sure that you're going to make enough money on the property or the building or the investment to pay the debt, okay? And when we start negotiating, and that's something that I want to teach you about tonight, is how to negotiate your commercial loans. Because if you have a lender that says, I want to see a 1.25 DCR, they're actually asking for that property to perform much higher. So what we want to do then is negotiate it down, and I've seen 1.112 in today's market and 1.10, and it just depends on how strong you are as a borrower and the building. The lower you get that, the better it is. Okay, I'm going to excuse my glasses. Okay, so, okay, going in. Hey, please have a seat. So the point is that as we get going here, the DCR, or DCF, I'm sorry, DCR, that's one of the things that we look at. How do we get net operating income? Anybody? Okay, go ahead. Net operating income is your income minus your expenses. But not just capital expenses. It's called recurring expenses. Expenses that happen on a regular basis. It's really important that when you work with your property managers, you don't know if you're going to sell the building today or if you're going to sell it in 6 years, but if you keep your books and records done correctly, it's going to make it a lot easier to be able to put it forward and show that you've got a property that's working. I'll give you an example. I was involved in a $12 million apartment deal a few years ago, and we got the books and records in, which we do during due diligence, and we started what we call scrubbing them. And so as we're going through it, this guy was charging $90,000 a year in cell phones against this property. I called him up and I said, did you guys put another zero on there that you're not supposed to? No. He owned a construction company, and he owned this company and this one. Well, he just, for whatever he was doing, he put all of the cell phones on one property instead of putting them in the different businesses they probably should have been. So when we backed out $90,000 against the income, that just, we put about $6,000 of cell phones towards the building, and we were able to add another $84,000 to the bottom line, as we call it, or the net operating income. So it's important that when you look at these, you replace an air conditioner. Okay, an air conditioner is not a recurring expense. Hopefully you don't have to replace them more than every 10 or 15 years, right? Or whatever. So the point is that you, that's not a recurring expense. And your property managers especially, they bill you for the air conditioner and they just throw it in your operating numbers. You need to educate your property managers, and I do it every day, to pull those out and put those down below the line or capital expenditures, okay? Not this Tuesday, but a week from Thursday, we have Ann Cornelius coming, who's a CPA, and we're going to be talking about cost segregation and depreciation, accelerated depreciation. And for example, your air conditioner would go on accelerated depreciation, so you could, but you would depreciate it and it would be on a different schedule than the building. It's pretty cool. We'll talk about that later. So we have NOI, we have, and then we have loan to value. Pretty common, okay? If the building's $1 million and the loan is $700,000, we have a 70% loan to value. There's a little bit difference here. Let's talk loan to value, loan to purchase price, and they're different, okay? Loan to value is a percentage of the appraised price. Can we agree on that? But in commercial, sometimes, I sold a property last year. We closed at about $1.2 million. It appraised for $1 million. Okay. So the perspective is, instead of a 70% loan to value, I think we closed at about a 62% loan to purchase price. And in commercial, often, guys, an appraisal is one person's opinion. That's all it is. The lender certainly will use that. When you go with a commercial appraisal, it's completely different than your residential that maybe you're used to. A commercial appraiser is much more certified. A commercial appraisal is about 60 pages long instead of your residential that's, 8 or 9 pages long, right? And so what happens there is that they have to substantiate everything. Now, everybody knows I'm a CCIM. Here's the benefit. When I meet a commercial appraiser on site on your behalf, probably I don't want you there. And the reason being is because it's my job to sell him the building, the story on the building, whatever that is. And so I'm going to take copies of the leases, I'm going to take rent rolls, I'm going to take the contract, I'm going to run my rental comps and be able to prove them, and I'm going to run comps on the building, and I'm going to have a nice pretty package that I walk in and hand that appraiser, and a Starbucks in the other hand, okay? And I'm going to work with that appraiser going through units, make sure he gets in what he wants to see, chit chat. But the good thing is that we build the story for him. By the way, when we do a residential investment for someone, a fourplex or below, we do the same thing, okay? And I get some pretty good appraisals in for my clients. Not always, sometimes there's different. So that's kind of some of the conversation as far as different terms that you're going to hear. So let's start on an actual appraisal, or I'm sorry, let's start on an actual commercial loan, okay? How many people have bought just a single family home, right? And what does a good real estate agent tell you to do? Go get qualified and let's see how much money we can spend. Do you think it's any different in commercial? No, you've got to go in and get qualified. They're going to ask for your tax returns. They probably are going to require you to hold it in what we call a single purpose entity. That means an LLC or an LLP or a triple LP, okay? And the only thing that you're going to hold in that entity is one property, okay? And because lenders really do understand the difference that if you put more than one property in one entity, that and something bad happens, that the whole portfolio can go down versus just one asset, okay? So they're going to look at you personally. But here's the thing that they do that's a little different than residential loans. We're going to build a story for you. Okay, I'm going to pick on Mike because Mike's my buddy down here. Okay? So if I'm going to go get Mike a commercial loan, I'm going to ask him to give me a resume. It's not a resume like you're looking for a job. It's a resume because you're looking for a loan. And the resume is going to talk about Mike and Mike's experience as a investor. Okay? What does he own? What is he going to do? What is his experience? Now, I take brand new investors and we go get a commercial loan. And how do we do that? Then we get a marketing package from the property manager so we can prove to the bank, this is our property manager. Here's one thing that's interesting. When you do deeds of trust and notes for a commercial loan, you name your property manager, okay? Unless you're going to manage yourself. If you change property managers, you have to notify the bank that you've changed property managers. And do not be surprised, and a good property manager, from especially multifamily, will understand this, that lender probably is going to send somebody to the property manager and make sure that they know what they're doing. That's their asset. They want to make sure that that building's being taken care of. You know, they're not going to run off tenants or whatever it is. So that's some of the things that the banks do. The banks actually will do on-site visits of the property during different periods of the length of the loan. So, back to you as an investor. We're going to build a story for you. If you own 3 property, you own a triple net, you own an apartment building, we want to put that all together so that we can present it to the broker, loan broker, and say, here's Joe Blow, and this is what he can do. Now, if you don't have a lot of experience, that's still okay. Again, we're going to build a portfolio there. I will also include my own resume, my real estate resume, which, you know, without trying to do this, pat me on the back, is pretty deep. And the point is anybody that knows me, and the lenders do know me, they know that I don't disappear. You can call me 6 years later. I'll hopefully still remember you, I will, and be able to help you with any challenges that you have. Every investor that works with me understands that if you have a problem, I want to be your first phone call. And if I'm not your first phone call, I haven't done my job as your broker. Okay? So if you have a challenge with something, if your property manager you don't think is doing a good enough job, we dealt with this yesterday, I think it was, and it was a matter of miscommunication, and we got it straightened out. But the email from my client said, I want to change property managers. My next phone call was to the client, my next phone call was to property manager, and we just basically got it solved, and everybody's happy. Again, just a miscommunication thing. The property manager was not failing at all. But if he was, we would change property managers. So now you've built your story, right? And you go in and you're going to need your tax returns, and you're going to need your credit reports, and the lenders will pull this, and you're going to need your assets, and they want to know what your firstborn's name is, because they may be lending you millions of dollars. Even if it's a $500,000 deal, that's not chump change, would you agree? So the point is that now you're qualified, okay? And now we're gonna go shopping. Now at that point, Phoenix market is pretty hot, would you agree? We have a lot of properties out here that are going pretty quickly. So one of the things that I specialize in is finding off-market deals. And the off-market deals may not be at a lesser price than what market is, but it's not picked over, and you're not fighting investors over contracts. I have a contract out right now on a property that I think is an exceptional buy, and I'm against 27 contracts on the property. 27 contracts. I believe it's down to the top 3 contracts, and I'm in the top 3. So that's another story. But the point is, when you find a property that's of value, don't be afraid to write on it. So now that we've done this, we've identified a property. You're qualified, you've picked your broker. You've identified a property. Well, certainly your real estate broker is going to write a contract. We're going to negotiate it through whatever those terms are, and we're going to put it into escrow. But the second we start looking at a building, not even in escrow, we're just like, here's a package on a building. I'll send that package over to your broker with my underwriting on the building, and my underwriting will be a discounted cash flow spreadsheet, which some of you use. So the point is that I'm going to send my package, my work up on the property over to the broker, the lender, okay? And the reason I do that is because he's going to underwrite it, and they underwrite them pretty quickly, and they'll take those numbers and they'll say, this is your loan amount, okay? Now, that hasn't met appraisal yet, and it hasn't gone through all of the rigmarole of a loan, but they're going to say we can expect, let's say it's a 70% loan to value. I'm going to caution you, you're going to have another 5% in reserves in a bank somewhere, okay? We're going to talk about how we move that money later. But the point is that you're going to need to have reserves. So always figure that you need to have a 5% reserve on any offer that you make. So if you put down 300, you're going to need, what, 360 in the bank, okay? Now, so we have our entity formed. And the other thing is, when we start shopping, when you're getting qualified, go ahead and form your entity. Don't wait till we find a property. How about if we concentrate on the property itself, the books and records and the loan process, and you're not running around trying to do an entity. Do an entity when you're ready to go buy a building, okay? And you get your entity done. Here's a couple of things on entities. Don't name them after the property, and don't name them Bob Smith, LLC. The whole idea of an entity is to protect yourself. Don't name them after yourself, guys, okay? And in addition to that, do not name them after the property. 2822 East Tierra Buena, one of my entities, before I learned this, right? And I sold that building, okay? The state will not let you go buy another property with that because it's too confusing, right? So I have lots of entities. I have one, Equine Holdings, okay? Equine Holdings is one of South Pacific Holdings. When I form an entity and my attorney does it for me, here's what he goes, what do you want to name it? I go, I don't care, pick one. I don't care what they're named, okay? Some people get real funny about that. I don't care, personally. So now you've got your entity, you've got your loan broker in place. So the other thing is, when you start on the loan process, you're probably going to sign a document with the lender that says you're going to work with him. And I'm talking from the broker level. Why am I not talking directly with the bank? And you're going to figure this out in a few minutes. But the point is that broker is there to work for you, just as I am. And we liaison back and forth through you, through whatever, because our job is to work together and do a successful deal. We're not talking about inspections, we're not talking books and records, we're talking the loan tonight, okay? So, we have a loan, okay? Or we have a broker. You're probably going to have to pay a $500, usually I see that, $500 fee to the broker, and that will go against his commission at the end of the loan. Because he's going to do a lot of work on your behalf, and he's not going to do it for free, okay? And if you're going to start going over about $500 on a $1 million deal, you probably shouldn't buy a $1 million deal, okay? So that broker is going to take your package, and he's going to take the package on the property. And he's going to put it out. They actually have softwares now. They used to do it in person. But they're going to send it out to what they call all their correspondent banks. And then they'll get hits back. They might get 5 hits back in the bank. This bank over in Kentucky might say, we'll do the loan at this. And the bank in Kansas City will say this. And the Phoenix bank says that, right? So now he gets offers in from the bank. It's his job to define and know the banks to be able to decide which one probably would be the best one. And his job then is to present you with a couple of different options for financing when we get down to it. I have clients that tell me, well, you know what, I saw on the internet I can get a 90% commercial loan. Here's my immediate comeback. Have you closed one that way? They don't close, guys. I had a guy that told me he had a bank out of Chicago that was doing a 90% commercial loan, and a year and a half later he called me and said, can you send me your lender again? A year and a half later. Length of time, okay? We usually write a 60-day escrow because in today's world it takes 60 days to get a commercial loan in place. It may take longer. That's one of the conversations we have when we get down to it. How long of an escrow do we need? So if you have your entity formed and you have your package, your personal package and your resume and everything to the lender prior to finding the property, well, guess what? That can shave maybe 8 or 9 days off of the thing, off the escrow. And here's the other thing, guys. In today's market, the shorter we can write a contract, the better off we are. Now, we use a commercial contract, and one of the things about that is that we have a due diligence in there for books and records and physical due diligence, right? But we also have a financing contingency in there, and it is not like residential. There's a drop-dead date that your financing contingency is removed. And you may not be 100% at doc level, you know, your loan docs at title, but by that time you should be pretty well set. In today's market, in today's Phoenix market, if I get a 21-day loan feasibility, I'm probably doing really well. I like 30, but here's what happens in the commercial world. As long as you're really communicating with everybody and you're down to the wire and maybe you need 2 more days to get on a loan committee, it's my job to extend that financing contingency, and anybody will find, you know, as long as you're right there and you've done your job as a buyer, to extend that out a few days here. And I've extended maybe 3 times a couple of days because the banks are dragging their feet for whatever reason, okay? So don't be afraid of a 21-day due diligence. If we start running against it, we'll either literally cancel the contract or threaten to cancel the contract. And everybody knows I'm a redhead for a reason, okay? But the point is that that's part of the things that we do. So what else does the broker do for you? He needs to know his banks, okay? Bank A, and I'm not going to name names because they actually change, but Bank A, yeah, they'll give you a 75% loan to value, but their interest rate is a little bit higher than the guy over here. Amortization period is something to discuss, okay? They don't make 30-year loans, guys, in commercial. 25 is good, but I see a lot of 20 years, right? I'm sure Mark's seen some 20 years. They do 20-year amortization, so your amortization schedules are different, okay? And that's all right. That's just part of what we take into consideration in the cash flow. Now, the other thing is, it's not a 25-year loan. There's always a call on the note, and almost always it's 5 years, okay? There's a few 7 years out there, but the banks don't want to have their money out that long. So therefore, if you go for a 7, once in a great while I'll see a 10-year, but if you see those, you're going to pay a higher interest rate. Is that the right thing for you? I don't know. That's your decision. But those are the options. The other thing is, your commercial loan, once it's submitted to the bank, the whole package, which is probably that thick, goes to the bank. It's important to know, how often does the loan committee at the bank meet? Once a month? Every Tuesday? Because what if they just met last week and they don't meet again for 30 days? What's that going to do to my 21-day feasibility period? It's going to screw it, right? So the point is that your broker, your loan broker, needs to shop for you, okay? To fit not only your needs, but the contract needs, the property needs, the deal, the whole 9 yards, okay? Now, your broker is going to charge origination points. And people will go, well, I can go to the bank and not pay origination points. Banks have little boxes this big, and if you don't fit right there, you're not going to get your deal done, okay? Or they're going to come in at 50% loan to value. That may be okay with you. I have a client that did that 2 years ago. And his loan to value was 50% when we closed, but he had a lot of cash, and that's what he wanted to do because he wanted very low payments on the property. Okay? Again, it's his job. But typically, your commercial lender is going to charge 2 points. Okay? Now, that's not set in stone, but 2 points. And 2 points means 2% of whatever the loan is. That's going to be his fee. Now, it's important that we want those named as points or origination fee. We don't want it named origination fee on the paperwork. We want it points. And why is because for the length of the time that you own that loan, that you're involved in that loan, you can depreciate the points. Now, maybe it's only $100, but you know, $100 will buy me dinner, so call me and save the $100 and take me to dinner, okay? But no, why not use the government's money as much as you can up front, okay? So, that's the points. Now, let's suppose that he's got this bank for this one and this bank for that one. Okay, you've got 2 banks that you're negotiating against. And the banks give you what we call a letter of interest. Okay? LOI. Do not mix this up with a letter of intent that we as brokers prepare for you to to offer on a property if we don't want to go directly to contract. But letter of interest for the bank. And when you get that letter of interest, it's going to spell out the terms of your loan, what they're going to take to approve it. There's always big caveats in there, okay? So let's suppose that they say they will do it at this amount, loan to value, based on appraisal, this amount of interest rate, this amount of loan term, this amount of amortization. Here's your third parties. Now that might be a new term for you, third parties. Third parties will be the bank fees, okay? That's going to be for the bank's attorneys to draw the docs or review the docs or anything that they do. It's going to be your appraisal, and let me tell you, appraisals, commercial appraisals, the least amount that I've ever seen is $4,000. And they take about 3 weeks to do, guys, okay? So, it's not like a residential where, you know, it's, what, $500 and you go out and they have it to you in 3 or 4 days. It does not work that way, and don't think it will. I've had clients that have paid expedited fees because for whatever reason we needed to close sooner, and they've paid a couple $1,000s more to get it done, and the quickest I've ever gotten one done is 2 weeks. And that's with me pushing people that I know, okay? So that's called third party. Another third party, phase 1, phase 2, environmentals, ALTA surveys. If we have time tonight, we're going to talk about ALTA surveys a little bit because why they're important. Okay? But the point is that those are the third parties, and you don't have to pay those yet, but be prepared, you're going to pay those up front. Okay? So now you've got your third parties. Now, I've got 2 letters of interest in here from the banks, right? And I go, well, I like this one, but I don't like this little piece right here. It's your broker's job to go and negotiate that out for you, just like I would negotiate a contract. So we did one with a local bank here, and let's stop for just a second and talk about the banks. Banks have this amount of money that they're going to lend for multifamily, this amount that they might lend to Canadians, and this amount for residential, and this amount for office. And when that pool of money is gone, they bring in another pool of money. But here's what happens. The terms on that new block of money, is what it's called, block of money, will change, may change, okay? So maybe last month, Bank ABC was loaning, you know, we could get this done at this interest rate, and the next block of money comes in at a different structure. Or the bank will say, we're a little too heavy in multifamily now, we're going to back off of multifamily, we're going to go more for office. Okay? It doesn't mean in 6 months or 3 months or a year from now we're not going to be back at the same bank doing business with them for multifamily or office or whatever it is, because they do change. And it's important that you have a broker that has correspondent banks that he understands and can pick up the phone. And here's the other thing that happens. He may call me and say, hey, they're about, you know, that great program that you've been kind of pushing to your investors. Well, guess what? They're going to shut it down in another month. That tells me I need to get you guys in a loan in a building like now if we want that loan program. Okay? So we have our letter of interest, and let's suppose that we finally agree on the letter of interest. Okay, so now what happens? Let's understand that while the loan interest is coming, we're out doing our physical inspections, our books and records. By the way I work, it's not the way every agent works, but the way I work, we do books and records first. Because if we scrub the books and records and they're not what we want, we kick the deal before we pay for third parties and inspectors and all of